A plummeting U.S. jobs report rattles Wall Street. Here to discuss it is Alexander Morris of FM Investments. Alex, the U.S. economy shed 92,000 jobs in the month of February. Is that number as bad as it looks?
That number is certainly as messy as it looks, but it may not be as bad on its face. January was optimistic, and we knew that. February usually would correct. We saw that as well. Some of the number here is off by 30,000 jobs that went on strike at Kaiser Permanente in the healthcare sector. If we pull that out, things are looking less bad, perhaps. But I think the number that investors should really focus on from jobs is since Liberation Day, April last year, we've shed twenty thousand jobs as a country. And that sort of slow deterioration, I think, is the more interesting and more alarming statistic than what happens on any one messy month to another messy month.
Outside of healthcare, as you mentioned, are the job losses in any other particular sectors or across the board?
We're seeing some more across the board gradual job losses, 12,000 in manufacturing, 11,000 in warehousing and transportation, another 11,000 in tech, 10,000 from the president's greatest enemy, the government itself. So we're not seeing any one sector that's really faltering. We're just seeing a gradual low hire, low fire, slight deterioration. We see folks just generally coming out of the labor pool as well. And we put all that together, and what we see is just slow deterioration, but nothing that anyone could put their finger on and say, this is how we're going to solve it. And a sudden rate cut isn't going to fix that sort of thing. And certainly some of the spikes in commodities prices we're seeing are certainly only going to make that worse.
The unemployment rate ticked up to 4.4%. How concerned are you about that number?
Not worried at 4.4. That's still pretty low. We have to remember, even in a perfectly humming economy, there's still unemployed people for myriad of reasons, some positive and some not. We'd be worried if we see that number to get to 5 and sort of break trend and make its way closer to 10. But 4 is still relatively low given asset valuations and given just the slow velocity of job turnover in the economy.
With oil prices spiking, as you mentioned, how critical a moment is this for the Federal Reserve?
It seems every time investors are facing a Fed meeting, it is the next most critical ever has been Fed meeting. This is no different. And what's a central banker to do with the concern of stagflation, which is sort of the enemy of both central banks and equity markets, with relatively sticky wage inflation, inflation overall, headline numbers that aren't going away, and now all of a sudden a new, fresh inflationary set of fears from conflict in the Middle East driving commodities prices, tariff rebates that are going to start to come through the economy in an uncertain replacement regime. So far, it seems that the best thing the Fed can do is do nothing because there's no clear impetus to cut, even though it may want to, when it said it wants to. There's a lot of fear over the horizon.